The debt market is sending warning signs to high-flying stocks, sparking concerns among investors about the sustainability of recent gains. As global bond yields rise, investors are becoming increasingly cautious about the level of risk they're taking on in equities. This shift in sentiment can be attributed to several factors, including the Federal Reserve's hawkish stance and the European Central Bank's decision to scale back its quantitative easing program. One key indicator of this trend is the surge in 10-year U.S. Treasury yields. In recent weeks, these yields have risen from around 1.8% to over 2.5%, a significant increase that reflects growing concerns about inflation and interest rates. This uptick in bond yields has led to a notable decrease in stock market valuations, particularly among high-growth stocks. The shift in investor sentiment is also reflected in the recent performance of popular exchange-traded funds, ETFs, focused on growth stocks. According to data from Bloomberg, the Invesco QQ ETF, which tracks the tech-heavy NASDAQ 100 index, has seen its year-to-date returns decline from around 30% at the start of 2023 to just over 10%. Similarly, the Spider S&P 500 Growth ETF has fallen from a high of nearly 25% in January to around 5%. Despite these developments, some analysts argue that the correction in high-growth stocks may be an opportunity for long-term investors. While the recent decline in tech stocks is concerning, it's essential to keep things in perspective, said Emily Chen, a portfolio manager at Fidelity Investments. We're still seeing strong earnings growth and attractive valuations in many sectors. However, others are more cautious, pointing out that the rise in bond yields has significant implications for corporate borrowing costs. As interest rates increase, companies may find it more challenging to service their debts, potentially leading to a credit crunch. This scenario could have far-reaching consequences for high-flying stocks, which often rely heavily on cheap and abundant capital. The impact of rising bond yields on stock market valuations is also evident in the recent performance of popular high-growth stocks like Tesla and Amazon. While these companies continue to deliver impressive earnings growth, their share prices have come under pressure due to concerns about interest rates and inflation. According to data from FactSet, Tesla's forward price-to-earnings ratio has fallen from over 80 at the start of 2023 to around 40. As investors weigh the risks and opportunities presented by the debt market jitters, one thing is clear. Caution is warranted when it comes to high-flying stocks. While some sectors may offer attractive valuations and growth prospects, others are likely to face significant headwinds in the coming months. In conclusion, the recent developments in the debt market serve as a reminder that investors must remain vigilant and adaptable in today's fast-changing markets. By keeping a close eye on bond yields, earnings growth, and corporate borrowing costs, investors can make more informed decisions about their portfolios and navigate the complex landscape ahead.